Good evening. Thank you for attending. My name's Rob Curry, and on behalf of all of the Nedbank Private Wealth host team, it's my pleasure to welcome you to the London Stock Exchange. So, when we were thinking about an investment update, we decided that it was most important to do it in person. The pandemic's meant that we've lent on our other communication channels, namely commentary and evaluations, bite-size explainers on our websites in video format, and broadcasting through webinars. But given what's happened in 2022, we thought it was time to revive the in-person communication channel. And 2022 has had a number of elements brought up in this year that we haven't seen for a very long time. War, inflation, rising interest rates, deglobalization. And so it's with that backdrop that we wanted to show you how we were protecting your savings and to share with you the analysis and thoughtful insight that's gone into the changes we've made to your portfolios throughout the year. The other thing we'd like to cover is our view on 2023 and the opportunities and threats that have gone into our assessment for what next year holds. Now, to do that, I'd like to introduce you to our Chief Investment Officer, Tom Caddick. So Tom is going to illustrate the main drivers of the investment markets this year. And he's going to have some help from one of his team, Simon Watts. Simon's a trained economist, and he's a senior investment analyst with us. And in conversation, Tom's going to also introduce Charles Stanley Kerwin. Charles is the chairman of Atlas Infrastructure. And we'd like to shine a light through Atlas as to why we're investing in infrastructure as an asset class. Once Tom's concluded, we then asked John Sopel, the author and journalist, to give us his views on the geopolitical issues that have had an impact on wealth allocation. Most of you, in fact, many of you will know John from his time as the BBC's North America editor. John, thank you for being with us tonight. So, having set the agenda, it's my pleasure to introduce Tom Caddick.
Thanks, Rob. Well, a very good evening to you all in the very heartbeat of the financial district here in London, and a very warm welcome on a cold, wet, miserable autumn day. Now, you might think that that is a really good metaphor for markets at the moment, but I think it's not, because actually there's a lot of interesting things going on at the moment. But I was hunting for an analogy to the markets at the moment to really set things off. And when I was going through the slides the other evening at home, my 6-year-old, my youngest daughter, came over to me and asked me, "Daddy, what is it you're doing a presentation on?" And I started to tell her. And she glazed over and she said, "Is it about sloths?" And I said, I had to admit it wasn't about sloths. So this presentation is not about sloths, but it is about another sort of animal at the moment, and that is markets, which, to be fair, have been misbehaving a little bit of recent. And I'm going to talk to you about some of the things that we've been doing. We're going to wind the clock back almost 3 years, look at some of the key movements in markets, some of the key events, and hopefully just follow through some of the cause and effect that we've seen over that period and what we've been doing on portfolios to either position to try to benefit, to try to protect, or in some cases just to react to changing environment. So, it has been a funny old time on the markets, and I think we'd all agree. We've wound it all the way back to just before COVID really started to kick in. And this is just looking at the global markets we've got here. And you can really see right here, this is where COVID really started to kick in, which is sort of February in early 2020. First started to get those reports. The oil price at that point, we saw a meltdown in markets. The oil price actually technically fell to a negative number, which is a strange thing, but it accounts for the storage cost as well. We saw US job losses, 20 million, record losses. So one of those markets that didn't employ any kind of furlough scheme. But then we started to see the impact on GDP, which was effectively a massive drop as the whole world locked down. But we started to see markets recover. We started to see them getting ramped up. Part of it was the lockdown trade, where you started to see some of those stay-at-home stocks doing so well, particularly in parts of the US, the Pelotons of this world, Netflix, which did so well in that period. But we started to see a reopening. And this phase here, which we're going to go into in some depth, we started to see that economic unlocking. Some of you might remember the Evergreen ship that literally got stuck trying to do a three-point turn on the Suez Canal. That was one of those first warning shots, I think, of supply-side pressures coming through, because that actually caused a real supply ripple globally in terms of the supply of goods. Realistically, the wrong goods in the wrong place at the wrong time. We started to see some of the more geopolitical events coming through. Yes, we saw a new incumbent in the White House. We started to see some issues coming out of China coming through. And then as we started to ramp up, we started to see central banks starting to respond. So we say hawkish. Basically, it's just getting a little bit more aggressive in terms of being less accommodative. Bizarrely, I don't know why we put Turkey in here, other than as an amusing, because while everyone else is raising rates, Turkey's been lowering rates. And incidentally, their inflation's at 85% now. But as we go through, we started to see the invasion coming through and having a knock-on effect. We started to see some things closer to home here coming through. And of course, we've started to see inflation really kick in. But if we look back to that post-COVID bounce, as we've sort of talked about it over the past few years, we sort of talk about it as that economic reopening. And in that event, there are lots of ways in which we can track it and try and understand what that really means on the ground at the time. A really good way of looking at it is the Pret Index. That actually gives us some real-time information. And this just tracks sandwich sales in the UK across the network of Pret shops. And this, as you can see here, that's the unlocking. Those are restrictions here in the UK being lifted, and a massive ramp up in sandwich sales. This one, Omicron and Christmas, if you're wondering, it's really continued. And if we look at that, also in terms of flights. So again, we can track UK flights. This is looking at domestic travel, international travel, brief unlocking, and then really starting to take off. Now, all of this plays to increased economic activity. So how do you benefit from that? Well, one of the areas that we look at and have invested in is commercial property. Now, we think of commercial property as being a real bellwether of economic activity. It's quite cyclical. It does tend to track with the economy. And back here, where you saw an absolute drop in the value of commercial property. Now, where we've invested, for many of you here in the room, is in a number of different areas. But one we did like, we continue to like, is a balanced commercial property fund. It's invested in a lot of UK commercial property. It has a value to it, but also it trades on the stock market. And the stock market will determine its current share price. So that got absolutely beaten as it went into lockdown, which is where we started to buy. Now, not because we liked the cyclical element, not because we liked the fact that it has a lot of exposure to the economy, which was quite frankly locked down, it's because it was pricing in significant downside, significant at that point. So we knew that if we started buying at this point, and we sat down with the manager on multiple occasions, and we saw a manager there who was looking over here. He was looking at his tenants. He knew that they weren't going to be able to pay during this phase, but what he did know is he needed to position the portfolio to be able to benefit from when the economy started to unlock. So we invested there. We started to see the vaccines getting rolled out, and it benefited from this big swell in economic activity. We started to trim the position up here across portfolios, largely because it had done so well, but also because we saw the signs of a cyclical downturn, where we started to see that economic activity starting to peter out and reverse. Now, one of the things about seeing that big push in economic activity is it is inflationary. So we think of this as being demand-led. This is massive increase in demand, as we saw, a big increase in demand across the world as we started to see economies unlock. You had a lot of pent-up spending coming through, and it was inflationary. So you had that demand-led pressure coming in, and at the same time you had other events. So you had the geopolitical. So wind the clock back to February, March this year, you had the invasion of Ukraine, and that had a very, very direct impact on more supply-side pressures. Combine that with the manufacturer of the world, who was still pursuing a policy, a zero COVID policy, and effectively locking down whole regions just on the back of a sneeze, and you had a real pressure. So that was creating supply-side pressures and a supply-side ripple coming through and meeting these demands. And that was creating significant inflation. So we saw some early signs, but it really started to take off earlier this year. And we've seen this sort of rocketing, multi-decade high levels of inflation pushing in. Now, what does all of that mean? Well, it has a real-world effect, absolutely. So we know that for all of us, the man on the street is really feeling the impact of inflation. Sunflower oil, interestingly, Ukraine produce about 30% of global sunflower and are accounting for, pre-invasion, 50% of all global exports of sunflower, which tells us a lot about a 230% increase. Wheat, Ukraine are, I think, about the 5th or 6th largest exporter of wheat, but just above them is Russia. Again, that tells us a lot about why this inflation has really started to kick in. So that's demand and supply pressures coming in. Jokingly, it is expensive to be a vegetarian because pork is only just about up. So how do you either benefit or protect? Well, something that we've talked about for portfolios for a while now. We didn't anticipate, I won't pretend, we didn't anticipate this sharp rise, the sort of 10, 11, 12% shift that we've seen in inflation. But we did know that we wanted to bake in some inflation protection into portfolios. And we've done that through a number of different ways, largely through real assets, and we'll come on to those in a bit, real assets, some of our alternative strategies that we've got in your portfolios, which have baked in some inflationary protection, be it upward-only rental rises, or in this case, renewable energy, a direct linkage to energy prices. Now, there are two major factors that drive the price of renewable energy and the price of an investment such as this. It's the price of electricity and how windy is it. Well, funnily enough, it's not actually been that windy. I know for most of us over the last couple of weeks, you'd beg to differ. It's not actually been that windy in the UK and across Europe recently. But absolutely, the price of electricity has shot up. Most people will know that electricity is linked to the price of gas. It pegs off of it and prices off of it. So we've tracked on here the gas price. And there's a direct correlation between the two. And we were buying in when we could, because they were doing a capital raise for portfolios previously at a much lower level, but have enjoyed this strong rise and have been trimming, largely not because we were anticipating a great fall, but largely because we felt an almost perfect scenario was being priced in to that particular investment. So for those who's got that in their portfolio, that's what we've been doing. And actually, we've been buying back. I should say that there are a few other factors that influence the price. And one of them might be policy, any prevailing policy, things like any support that the government might have, either renewable energy or energy sector generally. But it's also gilt yields in the case of the UK, so the risk-free rate. But we'll talk about that in a short while, because things turned a bit squiffy, as we all know, in the UK in September, October time. But that is a way that we've been able to benefit from this inflationary rise, or at least be able to provide some degree of protection for portfolios. So what does an inflationary environment then lead to? So this cause and effect. And I'm going to hand over, at this point, just when things are getting interesting, to Simon to talk us through it.
Yeah, thanks, Tom. So for all of Tom's pretty charts, this is actually probably the most important chart. This is when the kind of central banks got serious about combating inflation. You might remember, but the Fed in November 2021, they actually dropped the word transitionary, and they actually then thought, actually, we've got to do something about inflation to stop it from becoming entrenched, essentially. So what we've seen since then is a sharp rise in interest rates to combat that. What it also shows, this chart, is it's actually very hard, even when you start to get central bank increases in interest rates, is actually to forecast interest rate increases. Even the central bank themselves get it wrong. You can see that predictions in December 21 for the end of this year, the Fed were actually forecasting less than 1%. After the invasion in Ukraine, they were forecasting that end of this year, it would just be below 2%. And similarly, in June, only 3.4%. We're now at 4% in Fed funds, and they're predicting 3.25% for the end of this year. Markets have adjusted for this and moved up higher and higher. And currently, they're predicting around about 5% for the end of the year. Probably about 4.75 would probably be more accurate. But then we're currently seeing we're nearly the top of the cycle, and potentially interest rate cuts to come, but more interest rates at the beginning of next year, but then starting to come down. So in terms of what are we doing in regard to that, in terms of the portfolio, what we've been doing is adding to duration as markets are pricing in higher rates. Now, duration. No need to worry about that. If you want to have a conversation with me over a glass of wine, that's fine. But essentially, high duration is good when yields are high and about to fall. And low duration is good when yields are low and interest rates are about to rise. What we've done in terms of the portfolio, as you can see, the dark bar, is when interest rates and yields have been low, we've been protecting capital in the portfolio as they've started to rise. And then as more and more price increases, or expectations for price increases, or rate increases, I should say, have come through, we've been gradually adding to duration. And that's in expectation eventually of rates having to come down. So we're kind of looking forward to a slower growth environment and potentially interest rates coming down. So we're looking to protect the portfolio. The light bar is just essentially just a comparison to where the markets are in terms of duration. You can see we've got quite a big short position relative to the duration of the benchmark here, and then we're coming closer to benchmark duration, which is around 7 years. So this chart is pretty similar to the one Tom started off at the beginning of the presentation, but it's like the economic equivalent. So it just basically shows what's happened to economic growth, GDP, since December 19. You can see, obviously, the impact on growth of the virus. When everything shut down, we had a sharp contraction there. And then we've got, obviously, as vaccines were rolled out, we had then a more expansion. And then essentially when the restrictions were lifted, we have a huge jump in GDP and activity. More recently, we're seeing a slowdown in growth, and that's primarily, obviously, higher inflation, putting pressure on disposable incomes, but also higher interest rates by the Fed. Now, monetary policy does act with a lag, and it's long and variable lags, they say, in the central bank. And it can be 6 months to 18 months in terms of the impact. But we are starting to see the impacts of higher interest rates on growth. We're also seeing that impact coming through in terms of survey data, which is kind of a leading indicator of where we're going in terms of activity. So here we're showing kind of manufacturing activity or sentiment. And essentially what it's showing is in the US and Eurozone, we're seeing a slowdown in economic momentum. This is essentially the optimism that we're seeing within manufacturing in the US and Eurozone. Eurozone is even in contractionary territory. And that's obviously a factor of obviously high inflation, high interest rates, and also the energy supply issues that we're also seeing in Eurozone. So the impact of kind of, I suppose, slower economic activity, what are we doing in terms of the portfolio? Well, in terms of equities, we've become more defensive. What we've been doing is we've been reducing our exposure to cyclical stocks, which are termed here value stocks, and then moving into more quality stocks that are more resilient in terms of that economic environment, which could be more, I suppose, slower in nature and more challenging. So when we mean quality stocks, they are essentially described as stocks with robust balance sheets, kind of a steady cash flows, but also stocks with a greater margin protection, which also helped in basically in a higher inflation environment as well. We did benefit well, actually, from value stocks in the cyclical upturn after the COVID crisis, but now what we've been doing is basically reducing that and rotating into quality. In terms of fixed income, we've also been doing essentially the same, making the portfolio more resilient to the economic environment that we potentially face going forward. What we've been doing is selling out and reducing our exposure to high yield, which is more cyclical in nature, and obviously in terms of a slower growth environment can be affected by increasing amounts of defaults. And we've been increasing our exposure to government bonds. Combined with the fact that we've been increasing duration, which is the interest rate sensitivity, this should help insulate the portfolio when we eventually get a slowdown and lower interest rate environment. So again, preparing the portfolio and protecting the portfolio going forward. The other area that we've been doing is we really like real assets, especially in this type of environment. What we've been doing is in terms of within real assets, we've been reducing the cyclicality there as well. We've been reducing our exposure to real estate and commercial property, as it tends to be more cyclical in nature, and been rotating with it towards infrastructure, which is less cyclical in nature, less economically sensitive. You've got steady cash flow streams, and you've also got some inflation protection there as well. Within infrastructure, we hold Atlas Infrastructure. I mean, what we do within our entire portfolio is basically we have specialist managers within each asset class. And for infrastructure, we have Atlas. And at that point, what I'll do is I'll hand over to Charles, who's executive chairman of Atlas, to give us a nice run through, because he can do a much better job than I can, in terms of listed infrastructure and the advantages thereof.
Great. Well, thanks very much, and thank you for having me. So I'll try and go through why we like listed infrastructure, why we like infrastructure as asset class, and why listed is a good way to play that particular asset class. And it really touches on three themes that have already been touched on. So it touches on resilience in the face of GDP changes, inflation protection, and the ability to pass through changes in interest rates. So if I start with the financial characteristics of infrastructure. And what we're talking about here are things like electric, gas and water utilities, we're talking railways, we're talking toll roads, airports and communication infrastructure. And these types of assets tend to have the following characteristics. They're monopolistic and they have long-term, often regulated, predictable cash flows, which makes them very defensive in the face of changes in GDP. So they're less susceptible to fluctuations in economic activity. As their cash flows are predictable, they're also susceptible to the kind of discounted cash flow analysis which enables one to establish really quite precise valuations, and so to be able to calculate the returns on offer at any particular time in the market. And in many cases, as their regulatory contracts, their regulatory contracts allow them to pass through increases in inflation and increases in interest rates to the prices that their consumers pay. So in their negotiations with the regulators, they will have had the ability to push through those changes in costs, which means that their own earnings will again be resilient in an inflationary or in a higher rate environment. So a lot of professional investors access infrastructure through direct funds or the private markets. And that's great for them, but that's quite difficult for individual investors to do because those are long-term investments where you're locked in and they're not liquid, you can't get your money out. So, but actually, as this chart shows, the returns for listed infrastructure and for private infrastructure over the last 20 years have been strikingly similar. So you don't need to go into direct funds, direct markets, in order to get access to the listed infrastructure class. And that's not completely surprising because the assets in which you are invested tend to be exactly the same. It's quite easy to imagine that the underlying returns from a water company are going to be the same whether you've invested in it through a listed company or whether you've invested it through a private company. That's absent changes in the capital structure, but let's leave that aside for the moment. And while we're looking at returns, it's also worth noting that in the light green bar, which is the MSCI, in fact the same index that Tom referenced in his presentation, has actually performed less well than infrastructure over the last 20 years. And you can also, can't see it from this, but take it from me, that has been achieved at a lower volatility in the listed infrastructure market than in the equity market as a whole. The beta of listed infrastructure, if you're interested in that type of thing, is 0.6 to the overall market. So, in addition to their defensive characteristics, infrastructure companies operate in sectors that are right at the centre of the energy transition. And so they're going to be subject to an enormous amount of change and investment over the next decade and beyond. This data is taken from an IEA report, and it is estimated that the level of infrastructure investment will have to double from $300 billion a year annually at the moment to $600 billion a year by 2030, and that's going to progress onward from there. So that's a huge investment, and a lot of that's going to happen from by companies in the public market. And that's great because investors, regulators around the world are going to have to allow people making these investments, the companies in which we invest, the kind of returns which will encourage those investments. So that's a very good position for an investor to be in, where the regulator needs you to invest. And so as we're looking at this slide, it's also worth noting that the different sectors of infrastructure are going to have different opportunities. So you can see there electric utilities, transmission and distribution, think wires between generators and the houses they serve, are going to do well. Renewables, again mentioned, are going to do well. There's going to be a huge amount of investment required there. But things like midstream infrastructure, think US gas pipelines, for example, may be going to do less well. So there are winners and losers as a result of this transition. So those sort of arguments tend to apply both to the direct market and to the listed market. The next two slides, I'm just going to show you some things as to why we like the listed market in particular at the moment. And the first one is that if you look at the unlisted market, the shorter column there, you can see that there's $1 trillion of investment in that marketplace, and it's held by specialist funds. Almost by definition, those assets are being bought at an efficient price because they're subject to a competitive auction with other specialists, and they've been through a due diligence process. People know a lot about them, and there's very little that hasn't been uncovered by the time the lucky winner buys the asset. So that's a relatively efficient market priced off a certain return of the investor's cost of capital. Sometimes that cost of capital is very low. By contrast, the listed infrastructure market is about a $3 trillion market, over a $3 trillion market, and only about $150 billion, so less than 5% of it, is owned by specialist investors such as ourselves. The rest is owned by general infrastructure funds, by income investors, by ETFs, who are all subject to different influences, fashions and flows, which mean that the market moves around very differently. And that's really good if you're a specialist investor, because when the market is panicked and moving out, and you can see that you've got 10 or 20-year cash flows available at a very good price, you can buy it. And by contrast, if the market gets very excited and very frothy and then offers you a price which is actually not particularly attractive from the point of view of forthcoming returns, you can sell and rotate into something else. So market efficiency in the case of listed works in our favor. So the last point in relation to listed is that actually it's the beneficiary of the investment of the direct infrastructure market. The direct infrastructure market is raising over $100 billion of funds every year to invest in infrastructure projects, the sort of investment that we've been talking about. But actually, so far, the market has the available opportunity set has not kept pace with the money that's been raised. As a result of which, there is an enormous wall of what we call dry powder waiting to be invested, and that amount is now over $200 billion. And one way in which the private market is seeking to deploy those funds is by buying assets out of the listed market. And here you can see just a small number, or a number of the transactions that have taken place over the last few years. Each one of those represents a multi-billion-dollar company being taken out of the private market at a premium. And that's great if you're a holder of those, because then you get to sell something at a premium and rotate down into another opportunity. So if you are a believer in the idea that listed markets will continue to offer a less efficient pricing mechanism, you can expect this trend to continue, because we'll be identifying underpriced assets, and so will the direct market. And as the direct market looks for new opportunities, we expect this trend to continue. And that's also a comforting thought if you think that perhaps markets might wobble a bit in the future. This sort of represents an underpinning to the market from private investors. So, to summarize, we like listed infrastructure as an asset class because it's got relatively stable cash flow characteristics, which contribute to its defensive nature. It offers a degree of protection against inflation and interest rates in an environment where those things are worrisome to most investors. The energy transition offers dramatic opportunities for growth, and it's a relatively inefficient market in which a specialist investor can thrive. So that's the class. And just to tell you a little bit about us, so you know about the sorts of people that Nedbank is putting money with. We are a boutique investor specializing in listed infrastructure. And in fact, that's all we do. We're majority owned by Global Infrastructure Partners. Global Infrastructure Partners is a $70 billion private markets investor, probably the preeminent investor in that space. So we have infrastructure running through our DNA. That's all we do, all we want to do. We have a team of 21 people managing $2.3 billion in assets at the moment. And that is actually the largest specialist investment team in our sector. And we don't have time, or we haven't had time, to get into sustainable investing in this environment, or in this presentation. But as investors in long duration, often quite carbon intensive assets, we are determined to be a leader in sustainable investment. So we are a member of the Institutional Investors Group on Climate Change. We're part of that infrastructure working group. We were a founding signatory, one of only 3 boutiques to be a founding signatory to the Net Zero Asset Manager Initiative. We're a member, we've signed the UK Stewardship Code and the PRI. So we're really putting a lot of attention into that aspects of things to position us well for the energy transition. So with that, I'll hand back to our hosts, and thank you very much for paying attention.
Thanks, Charles. Okay, back to my pretty pictures. Now, we did think it would be slightly remiss if we didn't touch briefly on the events of the UK, and we were global investors, but on the events of the UK politically and the ramifications for markets over the past month. And it's been an interesting story, to say the least. And if anyone, this is not a party political broadcast by any stretch. I am a capitalist by heart. But it was a pretty good time for the Conservative Party during the COVID. You know, as we saw, they were seen as being relatively strong in their response and sort of fairly forthright in terms of the vaccination programme. That started to peter out when we had Partygate. But this is the sort of, and a bit of the sleaze allegations that you quite often get from a sort of a multi-term incumbent party. But it's the usual story that we saw. And then things changed. Now, I'm not sure, John might know this, but if anyone's heard of the Overton window, which is this idea, this concept of a politically acceptable window where policy will be accepted, taken on board by the public, by markets, and you always have to operate within that window. And it will be shaped and influenced by recent and current events. So, for example, you wouldn't be able to now, or 3, 4, 5 years ago, you wouldn't have been able to put in place, not that you'd want to, a policy of home restriction on the public. You wouldn't have been able to implement that policy. But put it into the context of COVID, and the lockdowns that we saw were perfectly acceptable. The public accepted that. But it occupies the minds of politicians because you always want to work within the window of acceptability. Because if you don't, this is exactly what happens. There are repercussions. You implement policy that isn't acceptable. And in this case, most people would say, actually, introducing a policy, a sort of a pro-growth policy, that sounds okay. But put that into the context of high inflation, high inequality in the market, and you're introducing this sort of inflationary policy coming through, fiscal policy that's being applied with, what was seen as benefiting the wealthy, and it absolutely was falling on deaf ears in the wrong environment. And that has repercussions. It has repercussions largely in terms of tenure. There's very, very quick turnaround. When we put this together, it was slightly worrying that sort of 4 of the 8, so 50% of the shortest term PMs have been in the last sort of 15 years or so, which is slightly worrying. But it has a very, very direct impact that moving outside of this is Overton window. But what does that really mean, and what did it mean for markets? Well, it had a profound impact. This budget, the mini budget that wasn't a budget, was indeed unbudgeted, had a major impact. Now, what this looks at is yield change. Now, this goes back to some of the slides that Simon was talking about. And it doesn't seem like much, saying a yield change, and this is the borrowing cost of a long-dated gilts. The borrowing cost has increased by 1.6%, or 1.6 percentage points. But that is a profoundly large amount to shift by. So this was the mini budget that wasn't a budget announcement, and a sharp shift upwards in yield. And a shift upwards in yield means a drop in value. We saw the Bank of England intervene. So you had fiscal policy coming through with monetary policy coming in to try to counteract it. Ridiculous situation to have. Bank of England intervened. Things started to improve. We started to see that. And we saw the first U-turn, which from memory was this, the cutting of the 45% tax. But the government decided to double down and carried on with the rhetoric of keeping with the spending plans, which were unbudgeted. And we started to see borrowing costs ramp up again. We saw the Chancellor sacked, things started to improve, and of course Truss resigned, so the PM resigned. Things started to normalise, but it had a major impact. Now, it doesn't matter which nation you are, but as the UK, as a Western developed nation, clearly you put a lot of store in stability, predictability. It takes a long time to build that reputation of stability, dependability. And this just looks at the daily returns of UK gilts. This is a safe haven asset. This is what people hold in pension schemes. This is all about the borrowing costs, absolutely, but this is why we invest in things like gilts. And you spend a long time carving out that dependability, and it can be absolutely trashed in a moment of madness. And this is the impact over just a couple of days. Huge variation in returns that came through. But that's the UK. It did have a ripple effect globally as we started to see some of those borrowing costs climb. We started to see the repercussions. Anyone will have seen Biden eating an ice cream, giving a comment on the policy. You know, it does have an impact. But there is, turning globally, there's a lot of noise out there. There is a lot of noise in the market at the moment, and it is influencing markets. But let's take a snapshot of where we are at the moment, and then how we're positioned. So, we've got high and relatively stubborn inflation. We're seeing it in the UK, we're seeing it across Western nations. Bizarrely, not necessarily globally, but we are seeing it across developed markets. But we're not calling the top here, but we're starting to see some signs of that peaking. Now, it's a very different position to be in if you've got, let's say, 8% inflation. And let's face it, 8% inflation is telling you what's happened. It's not telling you what's going to happen. But 8% inflation that's come down from 10% is a very different position to 8% inflation coming up from 6%. So we're starting to look for those signs of starting to see that peaking, because that has a big impact both on the psyche of investors and the markets, but in terms of the response that you might get from central banks. Talking of central banks, rates have been climbing. We can see that. Simon showed you that really boring slide that he was doing about rates going up. But it's interesting because we've seen those, but the markets are forward pricing mechanisms. They're not telling us what it is now, they're telling us where it expects to be. So yes, we've seen rates climb, and we can expect to continue to see upward movement. But what's being priced in? Can we expect a pivot imminently? Well, our central case is that I think it's probably a little too soon. The market is sort of gyrating at the moment with that expectation, but I think it will be coming in due course. So we positioned the portfolios accordingly. Geopolitical tensions at a near-term high, absolutely. We've seen Russia, Ukraine, and that we're moving into the winter period. We've seen Putin double down on his efforts there. We've seen a ramp up in activity between China and Taiwan. This can be quite unsettling. We have no answer to that, but we know we've got to position ourselves to at least protect as we can within portfolios. The manufacturer of the world. So we're seeing China continuing with their policy. If anyone followed the news with the recent Congress that they had, where actually they were doubling down again on the zero COVID policy. Now, interestingly, some of the market chatter at the moment is that they might start to see a softening. I don't see that at the moment in terms of this zero COVID policy, but that does create an inflationary pressure. But might we start to see that in due course, particularly if we see a successful vaccination program in China, which to date hasn't necessarily been the case. We're starting to see a dislocation between Main Street and Wall Street, where we're starting to see the economy behave slightly differently to markets, and that's partly due to markets being a more forward pricing mechanism. But here we're seeing record low unemployment. We're actually seeing continued reasonably good results coming through from corporates, despite some of this drop in sentiment. But we're still, at the same time, we're seeing high inflation. It's a very strange environment to see, and GDP is dropping off. But valuations are undoubtedly looking attractive. It's always a tricky one, because when you work in this industry and you go up there and say, valuations look good, is another way of saying prices have gone down, which isn't obviously the greatest thing to be talking about. But they are starting to look attractive on a relative sense. We're very cognizant of downside risk at the moment, given all of this noise that is out there and all of the permutations. So when we think about the portfolios, we think about different things and the need for diversification. It's not because we can't predict. It's not because we can't read the market. It's because there is a lot going on and we have to position accordingly. So we think of these three core scenarios: recession, inflation, growth. In a growth, out-and-out growth environment, and we're not there at the moment, that's where we want risk. We want lots of risk in the portfolios. You want core equities. That's where we have things like high yield. And that's how we were positioned previously when we saw that big ramp up. This sort of environment that we're in now, recession to inflation, well, if you go into a recessionary environment and you've still got high inflation, that is what's known as a stagflation environment. So high inflation, low growth or negative growth. But there are certain things that you can have to help and support you with that. That's where why we have things like renewables, things like care homes, which tend to be non-cyclical, as you can imagine, where we hold things like gold, can be quite a useful mechanism within the portfolio, and we've started adding where we can. Index-linked treasuries, so TIPS, things like infrastructure that Charles was just talking about can be very supportive in that sort of environment. Moving back towards a more growth, cyclical, well, that's where we hold commercial property, which is why we've cut back on our exposure there. But we still like it. It still gives us a long-term exposure that we like. Moving back into a more recessionary environment, quality equities that Simon was talking about just now, some of the more defensive positioning, areas such as government bonds, which are a very defensive asset, but given what we anticipate with recessionary environment, where we know we're going to start to see rates peaking, that is why we're getting more interest rate sensitivity into the portfolio. And we've moved away from things like high yield. So we've changed around the positioning of the portfolios. So where does that leave us on the portfolio? It leaves us with a number of themes that we've positioned for. As Simon was saying, we're positioning for the future, not for the past. We accept that it is a challenging environment right here, right now, for equities, but that will change. But for now, we've taken on a slightly more defensive position within our equities. As Simon was saying, we've taken on more quality growth. That will stand us up in terms of relative performance. For fixed income, we actually like fixed income a lot more than we ever did before. You know, when we saw interest rates down at sort of close to zero, German bonds were trading at negative yield. In other words, you were paying someone to invest with them. That made no sense whatsoever in our minds. Now we're in a different environment now. So rates have climbed. We're starting to like it far more, but we like the more defensive areas. So we like to take interest rate risk and not necessarily credit risk. Because if it's a recessionary environment, that's when default rates start to climb. So we've moved away from high yield into more government, get interest rate sensitivity. Real assets, alternative strategies, we really like at the moment in their portfolios for different reasons, but they give us really good diversification. Charles was talking about some of the diversification qualities that you get with infrastructure, and that's a really good reason that we like infrastructure. It gives us good predictability, good cash flow, some inflation protection. All of that is really strong. So we like real assets and alternative strategies. Finally, cash. We don't like cash, but we are holding it at the moment because, as Charles was saying just now, it keeps our powder dry. So we've had slightly higher cash levels, largely because we've been taking some of the risk out of the portfolios, but are getting ready to redeploy that into the portfolios once we start to see the environment change, which is when we want to start putting risk, really start putting risk back into the portfolios. So on that note, thank you very much.